Bank Indonesia just cut rates by 150 basis points. Banks responded with just 15 BPS. That's a 90% transmission failure. Here's why Indonesia's monetary policy isn't working. The numbers tell a troubling story. Bank Indonesia's benchmark rate sits at 4.75% after 6 consecutive cuts since September 2024. But commercial banks aren't passing savings to businesses or consumers. Even more striking, banks are sitting on 2.37 trillion rupiah in approved loans. That's $143 billion that companies simply won't take. This isn't about the cost of borrowing anymore. According to Indonesia's Employers Association, the real problem is investment climate uncertainty. Companies across mining, retail, and property sectors are adopting wait-and-see positions. Why? Regulatory changes, evolving compliance requirements, and concerns over operational parameters are creating hesitation around capital deployment. Manufacturing PMI has contracted since July. Credit growth slowed from 13.1% to 10.8%. Banks have healthy balance sheets with NPLs at just 1.5%, but businesses aren't confident enough to invest. Starting December 1st, Bank Indonesia introduced liquidity incentives to fix transmission. Banks that commit to cutting lending rates can reduce reserve requirements by an additional 50 basis points. The current reserve ratio is 9%, so there's meaningful benefit. BI is essentially incentivizing banks to cooperate on transmission, but there's another challenge: rupiah stability. The currency weakened past 16,000 against the dollar with $5.26 billion in portfolio outflows. This creates a classic emerging market dilemma. Cut rates for growth or defend the currency. The key lesson: monetary policy transmission matters more than policy rates themselves. LICAH Investment Academy analysis shows this is a textbook emerging market challenge. Central banks can lower rates endlessly, but if businesses won't invest due to non-monetary concerns, growth stalls. For investors tracking Indonesian exposure, watch transmission metrics, not just policy rate headlines. How quickly do banks adjust? Do undisbursed loans convert to actual credit? Those indicators reveal whether easing translates to real economic acceleration. Indonesia's situation proves monetary policy can't override fundamental investment climate concerns. When businesses hesitate, central banks push strings rather than pull levers. For more emerging market insights from LICAH Investment Academy, a regulated educational platform with verified compliance standards, visit the link in the description. Understanding these dynamics separates informed investors from headline chasers. Subscribe for weekly emerging market analysis. Drop a comment below: what other ASEAN markets should we cover next?